If you try to choose between trading Forex or crypto, or if you've been trying to use your Forex strategy on Bitcoin and keep getting stopped out, stop what you're doing. Most trading gurus will tell you that price action is universal. They say a chart is a chart, whether it's the euro or Solana. They are lying to you. If you try to trade crypto price action using textbook Forex rules, the market makers will use your account as liquidity. Because the truth is, patterns that work beautifully in Forex fail miserably in crypto. So in this video, I'm going to show you the exact structural differences between these two markets and expose 3 classic price action setups that work in Forex but will absolutely blow up your account in crypto. By the end of this video, you'll know exactly which market fits your style. Let's look at the charts. Hi, this is Marjan, and I use volume profile to decode institutional order flow. If you've been following my channel, you know that I don't just trade blind lines or basic chart patterns. I trade real transactional volume. When you look at the market through the lens of volume profile, the illusion of universal price action completely shatters. So you begin to realize that the price level is only as strong as the actual transaction resting behind it. And that brings us to the core issue. Before we look at the patterns, we have to understand why this happens. The Forex market trades over $7 trillion a day. It is controlled by central banks, massive international corporations, and global institutions. It is incredibly heavy, liquid, and regulated. Forex moves like a cruise ship, slowly, predictably, and with immense structural stability. Crypto, on the other hand, is a tech-driven asset class. Even major pairs like Bitcoin or even Ethereum have significantly lower deep liquidity compared to Forex. Crypto is driven by retail hype, leverage, and veils individuals or funds with enough money to single-handedly push the price. Crypto moves like a speedboat. It can change direction instantly, aggressively, and violently. Because of this fundamental difference, standard price action behaves completely differently in these two markets. Let's look at the example number 1. In Forex, classic support and resistance levels are highly respected. If you see a major daily support zone on Euro USD, for example, price will often approach it, slow down, and bounce cleanly. You can set up your stop loss right below the zone and feel relatively safe. Do that in crypto and you're dead. Because crypto has lower liquidity, market makers and whales look at obvious retail support levels as a giant pool of money. They know exactly where your stop losses are. In crypto, you will almost never get a clean bounce. Instead, you get what I call the liquidity hunt. Price will violently weak past the support level, triggers everyone's stop losses, liquidate the over leveraged long positions, and then skyrocket in the direction you originally thought. The rule is this: in Forex, you trade the level, but in crypto, you have to trade the stop run of the level. The second major difference is how these markets handle breakouts. In Forex, because of mean reversion, true breaks out are rare. If a Forex pair breaks a major resistance level, it often lacks the momentum to just keep flying. It usually creates a fake out, traps the breakout buyers, and pulls back into the range. In Forex, buying the pullback or trading the range is usually the safer bet. Crypto is the exact opposite. Crypto is a momentum driven market fueled by FOMO, fear of missing out. When Bitcoin breaks a major psychological resistance level, retail traders and algorithms pile in all at once. The breakout doesn't pull back neatly, it explodes vertically. If you try to short a crypto breakout thinking it's a Forex style fake out, you will get caught in a short squeeze that will wipe you out. The rule is this: Forex loves ranges and pullbacks. However, crypto loves aggressive, momentum based breakout trends. The final action killer is time. Forex runs 5 days a week. When it closes on Friday and opens on Sunday, macro events cause massive gaps in price action that you have to account for. Crypto trades 24/7, 365 days a year. There are no weekends gap. But weekends in crypto introduce a different kind of price action trap: low volume drifts. On Saturdays and Sundays, institutional volume leaves the crypto market. The charts become thin and choppy. Price action signals that look like a perfect reversal pattern on a Saturday afternoon are completely fake. They are just random retail noise. Then Monday morning hits, volume returns, and the real trend completely invalidates everything that happened over the weekend. The rule is this: treat Forex price action with respect during the week, treat crypto weekend price action like an absolute trap. So, should you trade Forex or crypto? Here is your answer. If you are someone who likes structure, predictability, strict risk management, using leverage safely, and you want to sleep peacefully on the weekends, Forex is your market. And if you love high volatility, trading pure momentum, riding massive emotional waves, and you have the patience to sit through wild liquidity sweeps, crypto is your market. Personally, I trade both, but I use two completely different sets of rules for my price action. Which market sounds more like your style? Are you Team Forex or crypto? Let me know in the comments below. And if you want to see exactly how I map out these trend lines and liquidity zones for the week ahead, make sure to watch my weekly market analysis video right here. Don't forget to hit subscribe, and I'll see you in the next video.